Hi, I'm Johanna Botta from StoneX. Markets are showing heightened volatility with rumors of tariff pauses and White House denials causing chaos in the markets. I'm joined by John Kicklighter, StoneX's global head of content. Hi, John. Nice to have you with us. There is a lot of volatility today. Can you give us a breakdown of what is happening in the markets?
Thank you for having me. It's a continuation of the volatility that we had last week when the announcement of reciprocal tariffs obviously had its significant impact on the market. I think there was a belief that the US government would not go through with the reciprocal tariffs and it would do a little bit of jawboning like we did with Canada and Mexico in previous months. And I think the full application took the market significantly by surprise. Obviously, a normal approach to this for an administration would be to, in turn, change your tune, offer some solace, stabilize the markets while keeping the pressure on trade partners so that they are better actors. Clearly, that's not what Donald Trump did over the weekend. In fact, he doubled down, I think, on the pressure to suggest that this is medicine that the world needs to take so that the U.S. can revive its position. And naturally, we opened the new trading week in the U.S. session to exactly what you'd expect with that kind of announcement. You would have a gap down and continued declines. Now, the volatility today, and actually the S&P 500 is looking at the biggest days range as a percentage of spot that we've seen since back in 2010. So it really does tell you what level of volatility we're dealing with here. But that would be prompted by some suggestions, some rumors that there could be a 90-day pause from one of the president's chief economic advisors, which was later denied by the White House, and then just all this back and forth volatility as headlines and rumor and conjecture are playing to markets' fears because they don't know how to price these type of risks.
The rumor that you mentioned, John, there was something in there about China being excluded from the 90-day pause. Do you think that this is playing into the long-term strategy of Trump and the White House?
I do think that it has an impact on the strategy or reflects the strategy, even though the rumor was later revoked or spoken against. I do think that there is some degree of consistency when it comes to China because they're considered to be the direct objective of trying to right as they see unjust trade practices across the world. In fact, Donald Trump, shortly before we started recording this, suggested that if China does not change its policies, that it would apply even further aggressive tariffs against the country. I think in the grand scheme of things, if China were to change significantly some of its trade practices, I think the White House would probably back down from a lot of its more friendly Western trade partners, but I don't think China has any inclination of doing so.
Do you think that we are going to see any semblance of stability in the markets anytime soon, or do you think that we should just get used to this extreme volatility?
So volatility works on a spectrum, and it is extreme conditions in the most literal sense of the term, and extremes do not sustain themselves. You usually have to come back to some degree of norm. However, just because we aren't seeing 10% or 8% or 9% moves on a daily basis, like we're seeing with some of the major US indices today, doesn't mean that we won't have a higher resting rate of volatility for the markets. This is very, very common, and it really does reflect something like we saw back in 2017 to 2018. 2017 was really hallmarked by the extreme low volatility across the capital markets. And then 2018, when we started to get into issues like the first trade war, really did revive those levels of volatility. And we were seeing higher day-to-day volatility. I think what we're likely to see is some of the top end of these extremes is definitely going to come down, but the markets are probably going to level out at a higher level of average volatility day to day, week to week.
So what do you think are the most at-risk markets right now? in these conditions?
The most at risk, yes, the most at risk markets in these conditions are going to be those that are most overexposed to. So you're looking at markets where we've already seen a significant decline. So let's say tech-heavy sectors of U.S. equities, which were the favorite up until about 4 or 5 months ago. You see areas like carry trade, where we were starting to back off because of monetary policy shifts to rate cuts. Those areas are already seeing that pullback, and I think that's why you have a little bit more of an evenly distributed risk aversion. So you can see it across equities in both the US and rest of the world. You can see it in emerging markets, high yield fixed income, carry trade, even commodities, which are starting to take something of a risk bent. And in fact, when you see more of that intensity and that breadth of risk aversion, I think it's indicative of a broader market's risk aversion, meaning it's more likely to turn into one of those trends. And obviously with something like the S&P 500, which is a benchmark for risk, already at the cusp of a technical bear market, was 20% from highs. I think that the markets are already aware of this, and it's just a more progressive de-risking as long as some of these threats are seen, or it turns into, let's say, trade wars into recession fears, which I think it already is. You're probably going to see a lot of that cyclical shift from the risk-oriented assets with a lot less of the dip buying into seeking out safety and stability where it can be found.
Well, that was my next question. I was going to end on an optimistic note. Where should we look for safety in these market conditions?
Safety is going to be difficult to find in any particular asset. We even saw through the end of last week that gold, which had been rocketing higher past 3,000, was a preferred safe haven. And that's in particular because it offers an alternative to traditional fiat currency like the US dollar, which obviously hosts the treasuries, and that uncertainty around trade emanating from the US. There's not a lot of alternatives to US treasuries and US dollar, but historically gold is one of them. But even through the end of last week, gold was seeing a pullback, and that's that escalation. So even though the US is at the center of these trade wars, it is still going to provide some of the better safety purely because of the market's seeking of liquidity. So the most liquid assets in the world are what the markets are going to inherently be attracted to. US dollars, treasuries, perhaps gold, but not to the same extent and not as the singular outlier. And alternative to the US dollar, we can watch the euro, we can watch yen, we can watch pound, but it's going to see a lot less appeal, especially when the intensity of risk aversion increases and liquidity is the only thing that capital holders really care about.
Thank you, John. And I'm sure I'll be talking to you soon. Things seem to be changing by the second around here. Thank you to our audience. If you want more content from StoneX, make sure you like and subscribe to our channel.